Think you need a massive bankroll to score massive returns in the stock market? Think again, because today I'm pulling back the curtain on a secret almost no one talks about. Welcome to the program You Can Surpass the Stock Market. Here I show you how you can reach the peak where few arrive in the stock market without getting overwhelmed. I am Francisco and I'm an expert in finding stocks that can top the S&P 500. Today, we are taking aim at a myth that has held countless investors back: the notion that only big investments bring big returns. So many people think you need to pour in huge amounts of money, tens of thousands of dollars, just to see substantial gains. They assume if they don't start with a large sum, they'll never get anywhere near beating a standard benchmark like the S&P 500. But is that really the case? Before we go further, let's clarify what we're talking about and what we're not talking about. We're talking about the power and potential of small stock market investments, relatively modest sums of money that can, when chosen wisely, outperform much larger investments. We're talking about leveraging knowledge, strategy, and discipline to identify high potential companies early on, even if you only invest a few $1,000s. What we're not talking about is gambling on penny stocks with zero fundamentals or chasing every hot tip on social media. We're not talking about get rich quick scheme. We're discussing a thoughtful research based approach to investing that allows even a busy professional like you to get better returns than just mindlessly following an index. By understanding this, you open the door to a world of opportunity that doesn't require you to put your entire net worth on the line. In this video, I'll break down what great returns on investments really mean. I'll show you why small investments can still yield exceptional gains. And I'll present examples, address your concerns, and guide you through the right and wrong ways to approach this. Stick around because by the end of this video, you'll have a new lens through which to see your investing journey. And what are great returns on investments? Let's define our terms. We often measure our performance against the S&P 500, a benchmark for the US equities market. Over the long term, the S&P 500 trends to return about 8 to 10% per year on average. If your portfolio can consistently achieve returns above that, say 12, 15, or even 20% or more annually, you are doing extremely well. Such returns compounded over time dramatically increase your wealth compared to just passively following the index. Now, what's not great? If you're working hard and you're still not beating the S&P 500, you're essentially leaving money on the table. The S&P 500 is a broad market measure. It doesn't necessarily pick winners. It just averages out performance across many companies. If you're picking individual stocks, you have the opportunity to identify growth earlier. Why settle for average if you can do better? There's a widespread myth that you need a substantial amount of capital to invest before you can expect meaningful gains. The thinking goes that if you only have a small amount, even a successful pick won't yield enough profit to matter. But consider this. What if that small initial investment could double, triple, or even increase tenfold over a span of a few years? If you start with $2,000 and it becomes $20,000, that's a significant jump. If you replicate that success a few times, you dramatically improved your overall portfolio returns, potentially outpacing broad market indexes. Part of the reason this myth persists is psychological. We often equate big with important. Large investments seem more serious, more substantial, but big returns are really about percentages and growth rates, not the absolute size of the initial stake. A 50% gain on a $2,000 investment is just as impressive in percentage terms as a 50% gain on $20,000 just on a smaller scale. Over time, these smaller successful bets can snowball into large gains. But how do you find these opportunities? That's where understanding what small stock market investments really are and how to execute them properly comes into play. A small stock market investment might mean different things to different people, but let's define it in a practical way. Suppose you have a portfolio of $50,000. A small investment could be putting $1,000 or $2,000, just a fraction of your total capital, into a particular stock. Alternatively, if you're just starting out, it might mean investing your first $500 or $1,000 into a single growth oriented company. The key idea is that it's not the entirety of your wealth and it's not going to sink you if it goes wrong. It's a controlled, manageable portion that allows you to test out opportunities without overwhelming risk. Many of you are busy professionals working long hours. Time is your most precious commodity, and analyzing multiple stocks deeply every single day might be impossible. The pain you face is feeling stuck in the rat race, stuck with mediocre returns, and stuck with the perception that you can't do better than the S&P 500 because you simply don't have the time or a massive bankroll. Small investments help alleviate this pain by offering a more flexible, lower pressure entry into the market. You're not forced to commit huge capital that keeps you awake at night. You can take a more exploratory approach. With this right research, you can find promising opportunities without needing to dedicate every free minute to this process. It gives you the freedom to learn, adapt, and grow your portfolio incrementally. The main benefit is the freedom to experiment and the possibility of compounding gains over time. Small investments allow you to build confidence gradually. When you start small, even if you make a mistake, the impact on your overall portfolio is minimized. Learn by doing. Over time, you refine your strategy by seeing that what works and what doesn't, all without risking huge sums. Potential outsized returns. When you do strike gold with a small investment, the returns can be proportionally huge, and you can scale up the approach in the future. Now, let's talk about three examples of small investments yielding great returns. Imagine back in the early days of a company like Shopify, and its early stage, you invested just $2,000. If you held on to that investment for several years, as the company's share price skyrocketed, that modest $2,000 could have multiplied significantly, easily turning into $2,000 or more over time. That's a 10 times return on a relatively small initial stage. Look at CRISPR Therapeutics. When it was still in the early stages of gene editing research, suppose you invested $1,500 before the company's successful clinical trials attracted broad investor attention. As the biotech firm demonstrated promising results and its treatments edged closer to regulatory approval, the market began to recognize its transformative potential. That initial $1,500 could have grown to $9,000 or more, proving that a carefully chosen small investment in a cutting edge sector can yield remarkable returns. Consider NVIDIA a few years ago, before the full breadth of its AI and data center opportunities came widely appreciated. Imagine you invested $3,000 back when most investors still saw NVIDIA primarily as a graphics chip market for gaming. As industries discovered that NVIDIA's GPUs were integral to artificial intelligence, machine learning, and cloud computing, the company's growth trajectory accelerated. Over time, this expansion was reflected in its stock price, consistently outpacing the S&P 500. That $3,000 investment could have easily multiplied tenfold or even more showing how a well-timed smaller mistake in a high-potential player can substantially outperform the broader market. These examples aren't about guessing winners blindly. They're about doing homework and selecting opportunities with the growth potential that the broader market hasn't fully recognized yet. I know you might still have doubts. Let's tackle three common objections that might be running through your mind. I barely have time to sleep, let alone dive into hours of stock research. This is a fair point. You're busy. Maybe you're in a high demand career, running a business, or taking care of family responsibilities. But consider this: small investments don't require you to become a market guru overnight. You can rely on curated information sources, reputable newsletters, analyst reports, or even platforms that aggregate research. Spend 30 minutes a week reviewing one or two companies. That's enough to gradually build a watch list and identify a few potential winners. Over time, you'll develop a sense for what to look for, cutting down the research time needed. Now you're thinking, great, I invest $1,000 and double it in a year. That's only $2,000. Big deal. It's easy to dismiss small gains because the absolute dollar amounts seem trivial. But remember, the key word here is growth. We're not just multiplying 1,000 by 2 and stopping. We're demonstrating a process. If you can achieve outsized returns with the small amounts, you can eventually apply the same approach to larger amounts as your confidence grows. Moreover, compounding works wonders. If you identify multiple opportunities like this over time, the cumulative effect can significantly move the needle, even if you always invest relatively small amounts. Outperforming the S&P 500 consistently for a decade can drastically change your financial landscape. But isn't this too risky? Small does not automatically mean risky. In fact, starting small can be a way to mitigate risk. You're not putting $50,000 into a speculative play. You're putting $1,000 or $2,000. If it doesn't work out, the loss is limited and you learn valuable lessons without catastrophic consequences. By carefully vetting companies, looking at their revenue streams, market potential, competitive advantage, and financial stability, you can pick smaller investments that are relatively safer. Plus, if you diversify these small bets across a handful of promising companies, you spread out your risk. The idea is informed investing, not blind gambling. At this point, you can start to see that the biggest hurdle is a mindset issue. We are conditioned to think that big results require big inputs. Yet, the stock market is rife with examples where early, modest investments led to impressive returns. The skill lies in identifying these opportunities, having the patience to let them grow, and not succumbing to the idea that only large capital allocations can yield significant gain. Next, let's examine a wrong way to approach this concept and the pitfalls it might bring. Then we'll talk about the right way and the results you can expect if you implement it properly. The idea of making small investments to achieve outsized returns can be incredibly appealing. After all, who wouldn't want to start with just a few $1,000s and watch that modest amount grow into something significant over time? However, like most worthwhile pursuits, success depends on doing things the right way. If you approach this concept half-heartedly, you can quickly find yourself on the losing side of the ledger. When we talk about the wrong way to execute this theme, we are referring to actions and habits that lead you astray from a disciplined, research based approach. Let's break down what that looks like and why it can be so damaging. One of the biggest pitfalls is talking the basic idea: small investments can bring big returns, and distorting it into a reckless strategy fueled by hype and emotion. rather than rational analysis. This misguided path often takes several forms. Perhaps the clearest sign that you're on the wrong track is when you find yourself chasing every hot tip you encounter. Social media, online forums, and casual conversations at the office water cooler are full of buzz about the latest can't miss stock or cryptocurrency. While it's true that some of these tips might pan out occasionally, most are just flashes in the pan. Relying on hype means you're not doing any due diligence. You're not reviewing the company's financial statements, understanding its competitive advantages, or considering its market position. Instead, you're just hoping that the collective enthusiasm will carry you to profits. This is little more than speculation, and speculation rarely leads to long term success. Another critical error is investing in a company without understanding its core operations. If you don't know how the company makes money, what its growth strategy is, who its competitors are, or what external factors influence its business model, you're essentially throwing darts in the dark. Without a solid grasp of the company's fundamentals, you never recognize when something changes for the better or worse. Maybe a competitor launches a superior product, the management team changes hands, or the company's sales begin to decline due to market shifts. If you lack insight into these dynamics, you won't know when to sell or when to hold. The result is that you are at the mercy of a market swings and sentiment rather than grounded in any form of rational analysis. A misguided approach often involves treating small investments as if they were chips in a casino, instead of seeing them as strategic, risk managed bets on well researched opportunities. You view them as harmless gambles. Just toss some money in and hope something sticks. The problem is that while gambling might provide a rush, it's not a sustainable way to build wealth. Without a plan, you end up making decisions on a whim, driven by emotions like greed or fear, rather than any coherent strategy. You might get lucky once or twice, but luck is not a strategy. Over time, luck tends to run out, and you're left holding the bag. If you adopt these flawed approaches, what happens to your portfolio and your investing journey? First and foremost, you're likely to lose money. Sure, each individual loss might be small if you're only investing modest amounts, but small losses can compound over time, just like gains can. If you continually chase hype, invest in companies you don't understand, and treat the stock market like a slot machine, the cumulative effect of those losses can become significant. You might lose thousands of dollars over the course of a few years, a sum that could have been put to far better use if invested wisely. Beyond the monetary loss, there is a psychological toll. Repeated failures and losses erode your confidence, making you doubt your ability to invest successfully. This is a subtle but powerful consequence. Once you start doubting yourself, you may give up on the whole idea of investing with small amounts, concluding that it doesn't work. In reality, it's not the concept itself that's flawed, it's your execution. When you give up prematurely, you miss out on the potential growth and rewards that a disciplined, research oriented approach could have delivered. Remember, the entire premise is that small investments, when chosen wisely, can outperform the market and grow substantially over time. By doing it incorrectly, you never give yourself the chance to see the potential become reality. Instead of finding that promising small cap company or that emerging biotech that could have multiplied your initial stake, you spend your time scrambling from one hot tip to another, never landing on solid ground. Another less obvious but equally harmful consequence is the time you waste. Reading sensationalized social media posts or chasing after rumors could have been invested in genuine learning. You could have spent that time understanding an industry's long term prospects, reading an earnings transcript, or comparing financial ratios across a handful of companies. Over months and years, this cumulative lost time means you never develop a systematic approach or gain the knowledge and intuition that led to consistently better decisions. Instead, you remain trapped in a cycle of reacting to external noise, never building your own analytical framework. From a broader perspective, failing to execute this strategy correctly means you never develop the discipline that successful investing requires. Successful investors typically follow a set of principles. They know how to evaluate a company, they maintain patience, and they understand the importance of diversifying but focusing on quality. By approaching small investments the wrong way, you never internalize these principles. Without them, even if you do stumble onto a winner occasionally, you won't understand why it succeeded or how to replicate that success. Finally, the long term cost of poor execution is that you remain stuck with mediocre returns that fail to beat the S&P 500. The whole point of making small strategic investments is to potentially outperform the market. If you don't approach this correctly, you likely lag behind the benchmarks. This means you're not growing your wealth as effectively as you could be. Over years or decades, the difference between matching the market and beating it can be enormous. By doing it wrong, forfeit that potential advantage. In summary, the wrong way to execute the theme of using small investments for large returns is to engage in behavior that's impulsive, unresearched, and emotion driven blindly, following hype, misunderstanding the businesses you invest in, and treating the market like a casino are surefire ways to erode both your capital and your confidence. The cumulative effect of these missteps is missed opportunities, wasted time, and subpar returns. If you want to truly capitalize on the potential of small investments, recognizing and avoiding these pitfalls is just as important as finding the right stocks to begin with. Now, what does the right approach look like? Before you invest a penny, know what you're looking for. Maybe you're focusing on companies with at least 20% annual revenue growth, positive cash flow, and low debt. Maybe you want companies that operate in secular growth industries, areas that are likely to expand for decades, like renewable energy, advanced healthcare, or cloud computing. The point is to have a checklist. Even 30 minutes of solid research can give you a sense of a company's fundamentals. Skim an investor presentation, read an earnings report summary, or look at a quick stock analysis from a reputable source. You are not aiming to become a full time analyst. You just want a rough but solid understanding of what drives this company's growth. Start with a small position. There's no need to go all in. Over time, watch how the company performs. Are they hitting their growth targets? Are they beating analyst expectations? If things look good, you can add to your position. If not, you can sell and move on, having lost only a small amount. If you identify three or four promising companies and invest small amounts in each, you're spreading your risk. If one doesn't pan out, you have others that might overdeliver. This approach balances risk and reward. When you follow a disciplined, research driven approach, You start building a track record of successful small investments. Each win boosts your portfolio and your confidence. Over time, you might become better at spotting these opportunities and more comfortable committing slightly larger amounts. This is how you gradually scale your success. Instead of making a single large bet and hoping for a jackpot, you're building a repeatable system that can yield multiple wins over the years. Another critical benefit is peace of mind. Know you invested based on solid reasoning, not rumors or fear of missing out, helps you sleep better at night. This stability is important for someone who has a demanding job and cannot monitor the market 24/7. You have a plan, a rationale, and you trust your process. That in itself is a competitive advantage. One of the best things about small investments with high potential returns is the long term compounding effect. If you repeatedly find opportunities that outperform the S&P 500, even by a few percentage points per year, the difference in your portfolio's value over a decade can be staggering. Think about it. If the S&P 500 averages 10% annually and you manage 15%, that 5% difference compounded over 10 or 20 years can significantly outperform a passive index approach. It means retiring earlier, achieving financial independence sooner, or having more resources to invest in your passions. If you're struggling to beat the S&P 500 and working long hours, you need a strategy that fits into your lifestyle. The beauty of the small investment approach is that it doesn't require massive upfront capital or day trade. It's about finding a few growth stories to latch onto. You're not trying to catch every big wave. You just need a few solid waves that can carry you above the average market returns. With the discipline, patience, and a willingness to learn from mistakes, you can gradually turn the tide in your favor. Of course, the stock market is volatile. Even great companies go through rough patches. When you start small, it's easier to hold through volatility because you haven't risked your entire portfolio on one pick. You have the emotional resilience to weather the storms. And if the company's fundamentals remain strong, that volatility can be an opportunity to add more at a lower price, eventually enhancing your returns. Emotional control is easier when the stakes are smaller. As your investments prove themselves, you can scale up carrying the same disciplined approach forward. This reduces the chance of panic selling or making emotional decisions. Two of the biggest traits to achieving returns that beat the market. Let's break it down into action. You might be thinking, this all sounds great, but what do I do next? Here's one small, manageable step you can take immediately. Identify one sector that you're personally or professionally interested in. Maybe you work in technology, so you have a good sense of certain tech trends. Or perhaps you're interested in healthcare because you've read about innovative therapies and see potential growth there. Choose one company in that sector that you find intriguing. Maybe it's a mid cap company that's well reviewed by reputable analysts and shows consistent growth in revenue. Spend just 30 minutes this week reading about that company. Check out their latest earnings report highlights, read a couple of investor oriented articles, and glance at their price history. If after this research you feel comfortable, consider making a small investment, just a few $100s to start. This single action gets you into the mindset of exploring small investments with the potential for big returns. By doing this, you're putting the theory into practice. Over time, you can repeat the process, gradually building a portfolio of small, well chosen investments. Keep track of their performance, learn from the outcomes, both good and bad. Don't expect overnight transformations. The stock market rewards patience, learning, and adaptation. By consistently following the right approach, you create a pattern of behavior that can lead to better returns. You might not top the S&P 500 next month or even this year, but over several years, the cumulative effect of these disciplined small bets can outperform a passive index strategy. You don't have to spend hours every day glued to financial news. All you need is a structured approach that fits into your lifestyle. Small investments are your training ground, your laboratory for experimenting with different ideas and methods until you find what works best for you. Imagine looking back in 10 years at a portfolio that started with a few well chosen small investments, positions that grew and multiplied beyond your initial expectations. Imagine realizing that your careful, incremental approach has outpaced the broad market, bringing you closer to financial goals you thought were reserved for those with massive capital or full time dedication to invest. If this message resonates with you, if you see this potential of small investments to yield large returns, hit that subscribe button. Here on, you can surpass the stock market. I'll continue providing insights, strategies, and tips to help you steadily improve your returns and top the S&P 500. We'll dive deeper into specific sectors, highlight promising companies, and refine the approach so it fits seamlessly into your busy life. By subscribing, you are taking a step toward ensuring you don't miss future insights that could guide you to better investments. Let's move forward together. Build a portfolio that not only matches but surpasses the market, even starting with small steps. Thanks for watching, and I'll see you in the next video. Stay motivated, stay informed, and remember, big returns can indeed come from small beginnings. Subscribe now.